Welcome back. I wanted to take some time and talk about the bond market. We haven't spoken about this in a while. We certainly had a lot of developments, Federal Reserve meetings, and non-farm payrolls, and a lot of other big economic numbers. We took the last time we took a look at these economic numbers about a month ago, and we painted the charts that showed an upward progress green, and those charts with declining numbers red. And I wanted to take a look, and we left the colors the way they were. I wanted to take a look to see how things have developed. So, skipping past the GDP, we have the home price index, which was trending higher over the course of last year, May, June, and then started to decline to the downside. We now see a steady decline to the downside. This did look negative at the time. It still looks negative now, so we're going to leave this a color red. Sales price for existing homes is also continuing to trend down. This is a long-term trend to the downside. The red PCE chart is still accurate as well in the sense that rising inflation, personal consumption expenditure continues to rise. That's a negative for the economy. But to highlight those charts, those trends that have really changed, take a look at the advanced retail sales. This was trending oh so higher. October, November, we hit pretty significant highs. But since then, we've started to move to the downside. So this will have to be changed to a red chart. Industrial production is heading lower as it was as well. Non-farm payrolls, we did put this as a red chart, but now we see as of the last report last week, really good numbers. This looks like a new trend to the upside. And the same holds true for the unemployment rate. It was red because it was slightly trending higher, but now the unemployment rate going down, that's a positive for the economy. And that looks like it should be painted green. The 30-year mortgage is declining quite a bit. I guess that would be a positive as well. So we have to turn that to a green. Capacity utilization is still negative. Durable goods is trending higher, so is business inventories. University of Michigan confidence figures are starting to look like it's trending higher. So it looks like we may have to change that to a green color. Housing active listings is starting to move lower. Now it's debatable whether this is a positive or negative. I mean, we could say, yeah, there's more homes, there's less homes listings, but maybe that means that there's more demand. With that said, we go down. New York Empire is still negative. Residential construction is still negative. Indeed job postings is still positive, and the PPI is still negative. So the real big changes are the University of Michigan confidence numbers and the advanced retail sales. That really is the big turn. This has been the big change, what we've seen over the past 1 to 2 months. Now, taking a look more specifically at the 10-year Treasury bond, that's the blue area chart, and the red line are the mortgage rates. They usually trade very similar, in a very similar fashion, but there is always a difference between the mortgage rates and the Treasury bonds. So the mortgage rates loosely reflect the average for a 30-year mortgage, and we can see when the 10-year bond travels higher, so do the mortgage rates, and vice versa. They both tend to go down. But what's important is to note the spread, the difference between the two. That is known as the mortgage spread, and it does not stay constant. This will waver. Take a look at this chart. The orange line, or the orange area chart, is the S&P 500. The black line is the mortgage spread. Again, the black line represents the difference between what we just looked at, the 10-year Treasury bond and the mortgage rates. And we see when the S&P 500 went down September, October, the mortgage spread went up. Why is that? Well, this moves for various different reasons, but one of the big reasons is that when we enter a shaky economic period of time, lenders are more nervous. There's more anxiety out there within the market, and those rates tend to go up. It costs you a little bit more to get a mortgage in respect to the present 10-year bond. But now that the S&P 500 has been trending higher, the mortgage spread is coming down, meaning the difference between the 10-year Treasury bond and a mortgage rate is contracting. And that's what we see here with this black line trending lower. We take a look at the total bond yields versus the S&P 500. The S&P 500 is a blue line. The red line represents all the different bond yields. If you were to add up the 1 month and the 2 month all the way to the 30-year, these are the total yields, about 50 points, so to speak. 5 would be 5,000 basis points. But we see the total amount of yield within the bond market. And we see, generally speaking, as the S&P 500 went up October, November of last year, so did the bond yields in anticipation of higher interest rates. What we're looking for, what some traders are looking for, is that these higher rates eventually are going to suppress the S&P 500. But it doesn't seem like that's the case even so far. We see the red line, the total bond yields are trending higher, and as well the red line, or the blue line I should say, the S&P 500 also trending higher. Consider now the total bond yields versus the spreads. Now the total bond yields is what we just looked at. That's the red line. That means that there's a greater amount of yield, that traders are selling bonds. You see, when yield goes up, it means the price of bonds is actually going down. The bond market has to offer a higher yield in order to attract investment money. So the bond yields are going up as the prices of bonds are going down. Investors are selling bonds. What are they buying? Stocks. Now, still, this does show an unhealthy economic climate within the bond market because the green line continues to trend lower. That means that this reflects the spreads. Every spread, the spread between the 30-year bond and the 20-year bond, the 20-year and the 10 and the 7, etc. In a normal economic period of time, we'd expect to see this green line go higher as the 30-year gets a little bit higher than the 20 and the 20 gets a little bit higher than the 7 or the 10, and they begin to spread out. What we're seeing now is a contraction. That contraction is the result of the inverted bond market, which is still very much here. Now, really quickly, this is the current bond activity. This is the change today. We see the big change was that the 3, 5, 7-year bonds, those yields went up the most. They're selling the most of these short, well, actually medium-term bonds. Not so much on the short side or on the very long side either. But this reflects the total bond yields. Now we see 1 month pays a 461, 2 month 467. For a 1-year bond, we have a 4.89% yield. Compare that to the 10-year at a 3.73. That's 116 basis points higher for the 1-year than it is for the 10-year. That is very much an inverted bond yield. And that's why we see these total spreads in this prior chart. The green line, that's why the green line is going lower, because the difference between the bond yields is contracting, or it has contracted and it's continuing to contract, meaning the 20 is below the 10. That's an inversion. The 10 is below the 7. That's also an inversion. Every time you see a bar to the right that's lower than its respective bar to the left, that's an inversion. We have a massive inversion between the 1-year and the 10-year. So if we expect to see a quote-unquote normal economic period of time return, and we see stocks are going up higher, and a lot of traders probably say, hey, the stock market's going up higher. But if we really want to see evidence from the bond market that the economy is strengthening, then we'd want to see the longer-term bond yields or the longer-term bond maturities, like the 10-year, the 20-year, go above the 1-year. And last but not least, remember in a prior video, we talked about what an inverted bond market usually looks like when it ends. And in 2001 and 2008, that occurred. That occurred when the 1-year plummeted. So I think it's very important in the time to come to see whether the normal bond yield comes back, how it comes back. Does the 1-year go down a lot, or does the 10 go up a lot? If the 10 goes up and passes above the 1, I think that would be a positive sign, because that shows that traders are selling the long-term bonds and saying, no, I want to buy short-term bonds. I think that the short-term future is optimistic, and I want to get involved. Conversely, if they're selling the 1-year bond, they're selling the short-term bonds, that means they're getting out of the short term. They're saying short-term, I expect a lot of trouble, and maybe that's going to coincide with negative stock market returns, as it did in 2001 and 2008. We hope this has been helpful. We'll look forward to seeing you back soon.